Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Today, we'll look at what's going on in the market. We'll try to catch up over the last week or so. We'll talk about CPI. We'll talk about retail sales. We'll talk about unemployment and what all of that stuff means for the market as we see it gapping up here today on a Friday. I did promise some of you, particularly my super followers on Twitter, that I would do a live stream soon, and I will hold myself to that, but I didn't quite have the time to make it happen today, so we're putting out a packaged video. We will do a stream very soon. If you enjoy my content, please give this video a thumbs up and subscribe to my channel. I greatly appreciate all of your support, and it allows me to continue doing this work. Now, we have much to discuss, so let's begin. As I look out across the markets this morning, Bitcoin is still hovering around 20,000, oscillating above and below it, and we're still consolidating in this range off the lows here that touched below the 2017 all-time high. We are creating an ascending pattern here, but because of everything going on in the economy, this doesn't mean a whole lot to me in terms of proving strength for Bitcoin. We're still very much along for the ride with what's going on with the rest of the economy. When I look at equities this morning, the S&P, the Dow, and the NASDAQ, they've all gapped up from their closes yesterday. And my Twitter feed has a smattering of bullishness this morning. People are seeing this move up in equities and thinking it means something. I'm more tempered in my interpretation. I don't necessarily think it means much, especially when we look at the reasons why the market has gotten bullish this morning. So we'll unpack that here in just a moment. But just kind of broadly speaking, the Fed is still tightening. We got a 9.1 reading on the CPI for last month, which is the highest value since 1981. But the market is already expecting that CPI has peaked at that 9.1% value. We don't know if that's true or not, but there are signs that perhaps we've reached at least a local top in the rate of change of CPI, and a lot of that has to do with commodity prices. If you look at what oil has done, it's been falling from the peak. Copper is down huge, which in some ways signifies a greater slowdown of the economy, as copper is used in so much development and building. A lower copper price usually suggests the economy is slowing down swiftly, but it also means costs are coming down. Steel, same thing, in a decline, and a bunch of other commodities, food-based commodities, look like this as well. So has inflation peaked? I can't say, friends, but when I look across the world at fertilizer shortages as a result of what's going on in Russia and Ukraine, the resulting diminished yields from the harvest because of that, which we won't find out about until September, October, November, plus a complete lack of long-term energy capex, money devoted to exploration and the expansion of capacity. That is not happening right now. So I suspect that inflation will remain stubborn in this environment, even if we were to enter a recession, because these items in many ways are non-discretionary. Oil, for example, goes in everything. And if the US is not expanding its own capacity, and we see OPEC struggling to increase their own production, there is not a strong case to be made for oil to simply come all the way back down here to 2020 and 2021 levels and for us to just move on. There is a structural lack of supply in oil, which is one of the most critical resources for all human society. So I am not ready to say that inflation has been slayed, but the market is certainly ready for it. And we got a couple of news items this morning that have given a little more credence to the bulls who are hoping for good news. One of those was the advanced monthly retail sales report. Now, the headline value of this is what always goes out to the media. That's what gets shared around. And in many cases, that's what guides the discussion. And when you look at the headline value, here it says there was an increase of 1% month over month and an 8.4% increase above June of last year. That sounds good, right? Same thing if you keep reading the blue part. April through June of this year was up 8.1% from the same period a year ago. Well, those all sound great, except when you consider that inflation has been higher than all of those values at all of those times that they mentioned. An increase of 1% from this month to last month in retail sales, well, inflation is up 1.1% month over month. An increase of 8.4% year over year for the month of June, well, CPI for the month of June year over year is 9.1%. So by that measure, retail sales is down negatively respectively minus 0.7% year over year. Real retail sales are not keeping up with rising costs. We can look at some of that here. This is a look at retail sales compared to real retail sales. Regular retail sales, that's nominal, that's not adjusted for inflation. Here in red, you can see it's up 8.1%, looking great. But real retail sales, adjusted for inflation, and this is my May value. I haven't even gotten the updated number for June into my chart yet, but you can still see it's negative. And with inflation printing a new high this last month and retail sales going up nominally less than that, retail sales remain firmly negative. Consumers are spending more nominal dollars, but they are getting less for it. That is a sign of weakening consumer strength. Another piece of news that came in this morning, consumer sentiment from the University of Michigan. They've been running this survey since like the 50s, and it's been at all-time lows. So the reading from the month of June was 50 on the dot. The lowest consumer sentiment value in history before last month was 51.7 in 1980. Here's a look at consumer sentiment going all the way back to the beginning. Now, my chart turns this line into a bunch of dots when you go back before 1978. Because they were running the survey quarterly back then, and we're looking at my chart on a monthly series. So there's some gaps here in the old values. But you can see when they were running it quarterly, the lowest rating was 57.6 for consumer sentiment. That was in 1975. And since then, the low has been, as I said, 1980 at 51.7. Well, we're now down here at 50. And the reading that came in this morning that got the market so excited was a reading of 51.1. So it ticked up 1 point, and it's still at the lowest value, now the second lowest value that we've ever seen in the history of this survey. And that's what's got the market excited this morning. We've got retail sales up 1% month over month, even though it's trailing inflation. And we've got consumer sentiment up a single point, even though it is the second lowest reading in the history of the survey. So you can really see how when we're in these bear markets, people will glom on to virtually anything, right? The market liquidity is thin. People's sentiment is beaten into the ground, as you can see here. It's not just consumers, market participants as well. They're weathered, they're worn out, they're exhausted, and they're looking for anything positive. And when we see all these commodity prices coming down, and then people suspect that inflation has peaked, they start to think, well, maybe the Fed will relax. Maybe they'll ease off their policy soon because they've been talking about how they want inflation to come down. But the thing is, CPI itself has not begun to reduce, even though we can see signs that some of the calculations that go into it might be getting better. Like we see oil coming down. That probably will help gas prices the next time that they run the calculations, and at least on a month-over-month basis, maybe it won't look so bad when we get the July numbers. I do see that line of thinking, but to think that that's what we need to climb out of the economic doldrums and to move forward into the next bull, that's not sufficient. It isn't enough. And in many cases, I think that we still have a considerable number of shoes to drop before we can say that this story has played out. And in a lot of ways, it relates to earnings and unemployment. So we've looked at this before a few videos ago. This is the summary of economic projections. It's a survey that the Fed governors show in their FOMC meetings, so you can get an idea where they think certain indicators will move into the future. And the one I want to focus on here is their expectation of the unemployment rate. If you look at the expectations here in these little yellow boxes, they're saying right now, for example, the unemployment rate is 3.6%. They believe, that means the Fed believes, that unemployment will be 3.7 by the end of the year, so a rise of just 0.1%. They think that by the end of next year, it will only be at 3.9%, rising only 0.2% that year. And then by 2024, the same interval again, up another 0.2% to 4.1. So they think over the next 2.5 years, they can continue to carry forth with their plans and unemployment will only go up 0.5% between then and now. Well, friends, I find that to be absolutely ridiculous. If you look at what I underlined in red, that was their expectation in March. You can see how it has changed. They thought unemployment would stay flat through the next 2.5 years. That was back in March. They've now softened that expectation to saying, you know what, maybe unemployment will rise 0.5 percentage point. But if we look at the way that unemployment has behaved in the past, that isn't what it does. When unemployment begins to rise, rise, it rises quickly, and it rises in a way that cannot be controlled by the Federal Reserve. So their tools to adjust policy are sledgehammers. They are not scalpels. Changing the interest rates and managing their balance sheet are the only two things that they can do besides tell the market what they want it to do. None of those tools are particularly refined at having a controlled release of pressure in the labor market. So if you look at my chart here, what I'm showing you down here at the bottom, first at the top is the unemployment rate. If you're not familiar with the way I style my charts, these gray bars in the background represent recessions. And this is going back to the middle of last century, 1950 or so. Now, what you're seeing at the bottom are some little clusters of lines. Where you see these blue lines are places where the unemployment rate rose 0.5% in a 6-month time frame, and these red lines are where unemployment rose 0.5% in a year. And if you'll notice, all of these instances coincide with my little gray bars, which indicate a recession. Even the one over here in 2020, you can barely see it because it was a single quarter. There's a little gray bar here. There was a recession here. It's happened every time, and there's been almost no instances where unemployment just casually drifts upward at a very slow rate of change, and we completely avoid recession. Every rise in unemployment for the last 70 years has been in a recession. So their projections are not based on historical data. They are based on feelings and what they're hoping will happen, and their intent to massage sentiment and keep the market from utterly imploding on itself, because they don't want to be forced to ease while inflation is still high. But I suspect they may not be given much of a choice. So when I look at unemployment and I see them talking about it going up 0.5 percentage point, but us not having a recession, while we're looking at all of this other economic weakness, I think it's extremely unlikely, particularly when we see unemployment tends to move. It moves quickly. It can't really be controlled, and it comes during recessions. So we've got the Fed talking about tightening financial conditions and not seeing unemployment rise. We've already shown that we believe unemployment is going to rise. And what also happens when financial conditions tighten is asset prices fall. When asset prices fall, unemployment goes up, spending comes down, and federal income is weakened. So the last chart that I want to touch on today is this one here, which is comparing corporate earnings to CPI changes over time. So at the top, we've got our unemployment rate, like we were just looking at, and this is showing the unemployment rate average per year. So that's why it looks a little different from my other chart over here. This is the raw monthly unemployment rate, which got all the way up to almost 15% in 2020. But since it came down really quickly, the average for the year 2020 is not 14, it's closer to 8. So that's why over here, my unemployment chart on this side looks slightly different. You don't see it all the way up here. But alas, this is unemployment, and it's going all the way back to the Great Depression. Down here at the bottom, we've got CPI in these green bars, year over year change. We've also got price to earnings ratio for the S&P, specifically the Shiller price to earnings ratio, which uses a 10-year average and some smoothing. The reason I want to talk about this is because the stock market is still very confident about earnings growth for the rest of this year. They still believe that we're going to see 9, 10, 11% earnings growth for the stock market. This chart here comes from FactSet, and it's showing the S&P with 12-month forward EPS, which is in the thicker, more solid line there. And you can see it's still relatively elevated as recently as May. I don't have their most updated values, but I believe that we still have a shoe to drop as far as earnings go. The market drawdown to this point was heavily related to multiples and to duration, to the rising of interest rates. But what we haven't seen yet is an adjustment down because earnings have weakened. We are in the middle now of Q2 earnings season, so perhaps in a week or two from now, we'll have better idea of what this quarter looked like and what Q3 may have in store. But what history shows us, when we look at the bottom of my chart here, is that when we go through periods where we have inflationary spikes, that's where these green bars rise really quickly, early. We had a few of these in the 40s during World War II. During these periods, earnings are weaker for the stock market. You see how this value falls as inflation is rising. Same thing happened here in the 70s. We had a sustained period of inflationary spikes, and during that time, earnings for the market saw a significantly weakened period. At first, people are still spending, and when that inflation seeps into the economy and it starts to affect people's ability to spend freely and drive expansion because the things that they must pay for are much more expensive, it has a negative effect on earnings. And when earnings come down, companies have to cut costs, and in many cases, that leads to higher unemployment. And this makes sense when you think about retail sales, like we were talking about earlier. We're in a higher inflationary period, and at first, we're still seeing positive retail sales from a nominal perspective. But when you peel back the layers and you look at inflation-adjusted values, people are getting less for their money. And that can only be sustained for so long before actual spending across the board comes down out of necessity. So where are we currently? Well, my values, as recently as earlier this year, were going the wrong direction. This does not match with history. We've got spiking CPI and earnings growth, PE, still remains relatively high. We haven't seen this begin to roll over and buckle downwards, but I do believe that that is coming, friends. I believe over the next couple of quarters, we will see a significant downgrade in earnings expectations for the S&P as the recession becomes more obvious to people who have continued denying its presence. So on a day like today, where I see the market gapping up on news that isn't really good, but the market is desperately hoping it resembles something positive, I keep coming back to the data that says unemployment is likely to rise. And when it does, that will confirm the recession. But unemployment is one of the most lagging of indicators. What we'll probably see first is a reduction in earnings. It may come in Q2. It may not really manifest until later this year. That's part of the agony about this economic situation, is that we have to wait for data to roll in on a weekly, monthly, quarterly basis. And as we do that and we see everything deteriorating around us, it just raises the anxiety level as we anticipate those numbers coming in and confirming the reality that we're all looking at. But alas, these things happen cyclically. While in many ways, there are things about the current market that are unprecedented, that are historical deviations, there are a lot of symmetries between what's going on in the market now and what debt-based systems have dealt with for millennia. A system that is completely reliant upon credit must at all times expand lest it collapse underneath the weight of its own leverage. There is an embedded obligation for growth in the debt-based monetary system. And as a result, austerity measures like we're undergoing now, attempts to constrain the monetary supply and remove liquidity, cannot be sustained for long before they meet the cold reality of math. And I believe sometime in the next calendar year, probably very much sooner than that, the Fed will be forced to stop tightening because the economy simply will not tolerate it any longer. Perhaps we see a blowout in unemployment. Perhaps the treasury market becomes dangerously illiquid, seen here using the MOVE index, which represents volatility in the bond market. You can see it is quite elevated. It's almost to the 2020 peak. It's getting into dangerous territory. Perhaps we see corporate bond markets blow out. Here we're looking at the spreads for high yield corporate credit and investment grade corporate credit. In both instances, the yields for these markets are above where they were at the end of 2018. And those market conditions are what forced the Powell pivot at that point in time. It isn't clear that that's what will cause them to pivot this time. It's also unclear that the pivot will look anything like it has in the past. But really, what I want you to have in mind as we go forward is that there are still considerably more stories to unfold in this economic maelstrom. We are not near the end of the play yet. And the stock market, for its part, while it has spent time in official bear market territory under 20% down, there is also still a lot of hope for upcoming growth, and that has yet to truly be threatened by the economic situation we're looking at. So I expect that reality to be met here in the next few months. Make sure you follow me right here on Twitter at TXMC Trades. I post a lot of my thoughts on here, my market observations, and I try to share whenever I'm going on to other people's shows and podcasts. My DMs are open, so you're welcome to message me if you have any questions. And we'll see what happens over the next few days. You know, we're actually pretty lucky. Next week is not the most crazy in terms of economic events. We've got the flash PMIs at the end of the week, but otherwise it's pretty much status quo. So we might be able to expect a relatively quiet week next week compared to what we've been dealing with all year. But the last week of July is when the shit hits the fan, friends. That's when we get FOMC, we find out what the rate hike is going to be, and we get advanced GDP numbers for Q2. That's where you'll start to hear a lot of confirmed technical recession talk, as we are likely to see a negative GDP value for Q2. I find it very hard to believe that it would be positive after everything we've experienced. And a second consecutive quarter of negative growth will have people talking about a technical recession. That isn't what the NBER uses to define what they call a recession. They have more indicators that they look at, but the traditional technical definition is that, and you will have people looking at it, and you'll have markets responding. That's something I'm very eager to observe and unpack with you guys. When I look at the FedWatch tool, this is on the CME website, and it uses the Fed funds futures market to predict where people think rate hikes will be with the next FOMC meeting. In this upcoming meeting, markets are pricing in about a 70% likelihood of a 100 basis point hike, a full percentage point. I can't remember the last time we had a full 1% hike in the Fed funds rate in a single meeting. It's got to be at least 20 years ago. I'll go try to find that data, but I haven't pulled it up. But this is a fluid target. There's still a 31% chance we get 75. No matter what we get, the Fed is keen to appear serious about an inflation problem that has clearly gotten away from them. So 100 seems extremely likely. And once we get to that point, Fed funds will be around 2.5%, which is not very far from the ceiling that I think that they will hit. I find it difficult to project a reality where they get anywhere close to the 3.5% Fed funds rate that they've targeted. And just using the 2-year yield as an example, every time in the past that the 2-year Treasury in the black line has been met by the federal funds rate, the red line, in a hiking cycle, that has meant the end of hikes for that cycle. It's happened every time we've been in a hiking cycle and the 2-year and the Fed funds rate have come to meet each other. That has been the end of the hikes. And when you look over here where the 2-year is, it is struggling to get above 3.2%. It's having difficulty pricing itself all the way up to the place where the Fed is screaming that they want rates to go. So my suspicion is, after their next hike of 75 basis points, or maybe it's 100, that puts the Fed funds rate right up here. The 2-year is right here, and maybe they get one more hike in. We'll have to see, but I am relatively skeptical that they will get more than another 50 basis points out of this market before they're forced to pause their hikes. We'll just have to see. So that's it. That's everything I wanted to cover today. We bounced around a little bit, but I'll be honest, guys, it's difficult to encapsulate all of my thoughts into a single video when there's just so much going on. If you have any questions or comments for me, make sure to leave them down below. I will read them. We'll give this market a few days to play out, and we'll talk again early next week. So until next time, be kind to each other, friends. Take care of yourselves and remain patient. There's still much more to play out here. We will talk again in just a few days. Cheers, everyone.